All right, so hello and welcome to another Monster Candle trading video. It is me, the Monster Candle Trader, and as promised, we'll be going over the trade that I posted on my channel recently in regards to the opening range gap trading model that ICT presented in 2024. So let's go ahead and get started. So we'll be looking at the USTEC chart, which is a substitute for, I believe, the NASDAQ. I'm in Jamaica, so I don't have access to that market, so I use this instead. And the first thing you want to do before you even go in front of the chart and actually start doing any kind of notations or annotations on your chart is to go ahead and go to forexfactory.com and have the settings set for you to look for medium impact and high impact news, because that will influence how you approach the market greatly. So it's May 6, 2025, and as you can see here, there are no high impact or medium impact news for the US market. So having that information, I'll show you how it will apply in regards to taking different trade setups. All right, so let's go ahead and move to the next slide. All right, perfect. So right now, as you can see here, we're on the 1 minute chart for the USTEC for the trading day, May 6, 2025. Now, as I mentioned earlier in regards to Forex Factory and what the news actually indicates on a day-to-day basis, if there is a case where there's no high impact news and you're looking to trade the opening range gap or just looking to trade the 9:30 New York session open, what you want to make sure to do is that not to take any trades prior to 9:50 a.m. macro. Now you would see ICT go in and take trades before, and he's ICT. The model that I am showing you is the model that I use and find success with. And from the 2024 mentorship that ICT did, he's the one that gave this advice. So you have like a framework to work around to prevent yourself from getting hurt in the earlier parts of the market where it's most volatile. If you can pay attention here, you realize that this gap here is an indicator that I'm using. Of course, you can always pause the video and take a look at the name of the indicator and you can have it added. It pretty much maps out the opening range gap, and this red dotted line here is the midpoint. Now, for this model, you primarily want to target the midpoint of the opening range gap as your initial bias. That's what the model is centered around. And what is the opening range gap? ICT has tons of videos on it. I believe he has like a video dedicated to going over the opening range gap, so I would highly recommend for you to check it out. But to summarize, it's where the regular trading hour close and where it opens, which is normally 4:14 p.m. in the afternoon, and it'll open at 9:30 a.m. in the morning. Where between that close and the open, it normally leaves a gap, and within the first 30 minutes, the market tends to trade to the midpoint 70% of the time. Now that we have a narrative in regards to a bias and where we're expecting the market to go, we're going to go into a bit of detail in regards to time. So first things first, in regards to time that I mentioned before, we're looking at 9:50 a.m., right? So all of the price action you see taking place here, we're not paying too much attention to it. The only thing that we're doing is to mark out the first presented FEG. Let me go ahead and zoom in on this real quick. Yes, so the first presented FEG here. Normally, I would have used this wick, but based on how this candle was printed, I decided to use just this range here as the first presented FEG. That's the only thing that I wanted out of this price run. And for the meantime, I was just being patient, watching to see what the price is doing. Now, market opened, ran a bit higher above these buy-side liquidity pools here. It's relative equal highs, right? See it right here. And then sold off lower, failed to take out what is May 1st, 2025 daily low. Now, this is very important. You want to have the London low on the chart, and you want to have the last 3 daily highs and lows on the chart. Because whenever the market runs these areas of liquidity for an entire session or for an entire day, it reacts very positively off of it. So if you're looking for a reversal and you see the market takes out these specific areas of liquidity, it tends to give a nice reaction and present opportunities for trade. And so if you pay attention here, the market ran up, came back down, taking out the daily low for May 1st, 2025. We'll go a bit into the actual trade here. Just in just a sec, but there's something else that's important to note. Whenever you're approaching the chart, after you look at the news and determine like, hey, is there an high impact news? Is there no news? And you decide on how you're going to navigate the market. Depending on the different market conditions, I'll make a video separately. I don't want to just say this is what you do on this day. I want to actually have a trading example of me navigating that day. Then I'll go ahead and tell you how you'd operate around each specific day. So it's one step at a time, and you see that it's actual practical, and it's not just me saying things just for saying things. Right? So how you want to approach a chart. After you establish what the news is going to be, the next thing you want to do is look at from 6 a.m. up to 9:30 a.m., right? And you want to take a look to see if you see any relative equal highs, any relative equal lows. You want to mark out the London high and low, which is between 2 a.m. and 5 a.m. You want to mark out the daily highs and the daily lows in the last 3 days. You want to look at the daily chart. Pay specific attention to wicks, mark out the midpoints, have that annotated on your chart. But the most important thing to look for is relative equal highs, relative equal lows, the daily highs, the daily lows, the London high, the London low. Once you have those on the chart, it will help you map out a narrative in regards to setting up your trade. So for this day, it is a previous day's low that was taken right before a specific moment in time. So if you pay attention here, this happened around 10:02. That's when the low was taken. And if you realize, instant displacement here, going above this short-term swing high here, creating a shift in market structure. Liquidity swept, really a very significant liquidity swept, immediate reaction, shift in market structure. This here is an amazing time to enter into the market, right? Now, let's go ahead and put it back to time. So it's 9:50 a.m., right? And here we're looking at this obvious liquidity pool, and at 10 a.m. it strikes. If it's the case where this didn't take place at this particular time and the market was consolidating, what you're going to have to do is wait on 10:30, right? So it's 9:50 to 10. Want to see how the market reacts? Wait on 10:30. And you're going to use the first presented FEG to go ahead and frame the narrative. What does that mean? Say, if it's the case where the market goes up through to the first presented FEG, you want to see how it reacts off of it. It's a bit hard to explain without this being the case for today. As I said before, the more examples I get, I will be able to go into more detail. But I will drop a gem at the end of the video just to give you an idea of what I'm talking about in regards to using the first presented FEG to frame a narrative and to go ahead and help you teach you patience. It's been really helpful for me, and it's pretty much just changed everything in regards to how I approach the chart, how I exercise my patience, and how I can just take clean trades without taking like a couple losses first. Of course, there's going to be losing days, but my biggest issue was that even if I have a winning trade, I would take 2 minor losses before I have the trade, which is cutting into my profits, and we don't want that, right? So if you pay attention here, the market, take it out, shift, entry here. Now, in the video, if you pay attention, you'd see that I'm telling you that we want to see the first presented FEG work as a support for price to go higher. We don't want to see it to hold a price. Immediately trades above it, tap it once, rally up into this FEG, what that was acting as resistance, came back down, failed to even go into this FEG, then price higher into the London's high, right? So this is pretty much a basic form of the setup. I don't want to do any kind of information overload. But if you go through the video, break it down in steps and apply it to your own charts, you'll go ahead and see exactly what I'm talking about. And let's go ahead and move on to the next slide. And of course, the gem that I was talking about in closing. If you pay attention to the 2024 mentorship, ICT presents the first presented FEG as an entry mechanism to go ahead and trade to the opening range gap or to trade to levels of liquidity, whether it be relative equal highs, lows, swing lows, previous day's high, previous day lows, previous session high, previous session low, things like that. But After watching his most recent commentary and listening to the X space, it presented the final piece of the puzzle that was missing. Because using that method alone, you can still make money, right? The only thing is that you'd find yourself in trades that you're not supposed to be in, and you take some losses before you actually get the wins. And that was one of the biggest obstacles that I had, because I wanted my wins to just be clean wins. This is the gem that will change everything in regards to how you approach using the first presented FEG. Use it as narrative, right? So, for example, if it's the case where you're trading in the session, you're looking to trade to the opening range gap midpoint, and you see an entry, you see the market trade above it, trade back into it, say at 940, right? And you're looking to see the market actually travel into the midpoint of the opening range. Normally, I would have just immediately taken that entry and hope that the first presented FEG holds and bring it to it. A lot of the times it does, right? Enough to where you can be profitable. But then there are times when it just trades through it back and forth, back and forth, back and forth. Then at a specific time, it would have ran off. Or it trade to it one time back at one above, one below, and then it runs off with the next candle. And then I'm too scared to be in the trade because I've taken two losses, right? And then I watch it run to the midpoint and then I'm upset. If you use the first presented FEG as narrative instead, what that allows you for is to have patience and wait for the first presented FEG to actually show you that it's the market is using it to push price to the respective area of interest, whether it be the open range gap or pools of liquidity sitting above a relative equal high or relative equal low. How does that look, right? So say that there is a news event, there's no news event on the day, you wait on 950, and whenever you look at the market, it trades to the first presented FEG, right? Trades below it, close, trades above it, close, and just generally start consolidating around it. First things first, if there is time distortion happening right there, you want to wait on the next available opportunity. You want to see how it behaves on the 10 a.m. time frame, right? So in the 10 a.m. time frame, it's still doing the same thing, right? What you want to do is simply wait until the 10:30 a.m. So say that it's in the 10:30 a.m., right? You're looking for higher prices. It trades and close above it, trade back into it, but instead of using it to propel higher, it trades back below it and close, right? If it's the case where you were just using it as an entry mechanism, you'd have taken several losses in that situation instead of waiting for it to be validated. The thing that you do now is you sit and you just wait. Once the market trades above it, trades back into it, and do a displacement higher, you know that at that particular time, that FVG has been validated. And what do you do now? If you're not using it as an entry mechanism only, you have to just use the other PD arrays that ICT taught to actually enter into the trade. It can be breaker, order blocks, inverted FEGs. You just have to find the one that you're comfortable with and use it. Me personally, I like breakers and I like inverted FEGs. That's the thing that works for me. And I'm telling you, go back and look into the charts and see if you exercise patience, wait on it to be validated, right? So say that it was going to be a 150 ticks move. And because you wait on it to be validated, it ran 13, you take 120. That's still a good trade. And that, most importantly, it helps you to maintain your capital. So that's pretty much it for today. As I said before, more example, more videos, and then I'll go into each and every step so that way you'd have something practical to go along with the theory as well. So that's the format that I'm going to be using. And there was FOMC today, so I decided not to trade. So it was a perfect opportunity for me to present this video to you guys. So thank you so much for watching. If you like these kinds of videos, like and subscribe. Take care.